Hello, family. Here's an important public service announcement provided by Cash University. Cash University sits at the crossroads of what you know, what you don't know, and what you need to know. So have you guys heard about this new legislation? It was enacted January 2026. It was called Catastrophe Savings Account. Has anybody heard about this? And what is it about? Well, it says here it allows you to establish a special savings account. You can contribute money from $2,000 to $250,000 is for applying towards your homeowner's insurance deductible, or if you don't have any homeowner's insurance, you can apply it towards the repairs needed on your property up to $250,000 in case of a catastrophic weather event declared as a disaster or emergency. This special account can earn interest, which would be tax exempt, and upon your death, it can pass on to your surviving spouse without any tax complications. Have you all heard about this? What is this really about? Now, when I ask you the question, what is this about, I'm asking what's behind this legislation being enacted. Well, that's what we are here to discuss today. So I am John Scranton, also known as Johnny Cash, and I created Cash University to bring information to the forefront that people typically are not aware of or maybe misinformed about. In this particular situation, homeowners insurance is really it's really not well understood. Very few people read their insurance policy, and the reason I know this because ever since I had my license since 1993, one of our jobs was to help people to get the homeowners insurance so they could get the loan to buy the house. And nobody reads that. They have it, they get it because they need it to get the loan. But it's when a few years later, after getting licensed, I started working with real estate investors, and there would be, the thing is that to buy properties pennies on a dollar, either at foreclosure or before they go into foreclosure. So many times I got a chance to talk with the homeowners and ask, why are you selling? And they would show me these different conditions. The home would have had a situation with the plumbing and how it deteriorated, the water damage deteriorated parts of the house, where, a house may have caught a fire next door and the smoke, transitioned over into their house, and the house had smoke all in the walls and it couldn't stay there. And where the roof, I saw one house, it was a family, husband, wife, and 2 children, and they had about 15 buckets. When it rains, they had 15 buckets catching water because they didn't have money to repair the roof. So there was a lot of different reasons that people fell short of realizing their wealth through home ownership. Now, I later learned that in many cases, their homeowner's insurance would have covered the cost of those repairs, but when they bought the homeowner's insurance, nobody explained the policy to them. They hadn't read the policy, and if they read it, they didn't understand. And if the insurance came out and denied the claim, they didn't know any better. They accepted it, and and that was the end of it in many cases. So I began to learn better, and actually when I got a public insurance adjuster's license. Now, a public adjuster represents the homeowner in insurance claims. So I began to educate people about their policy, show them how a lot of the damage in their homes were covered under the insurance policy, everything that I mentioned. Now, that transitioned to doing a lot of roof claims, and I helped start this roofing company. I created the insurance division of the insurance, of the claims division for this roofing company. It still exists, 5-star rating as of today. And one thing I noticed by doing a lot of insurance claims, the insurance company began changing the rules. Now, can you imagine that? They began changing the rules. And they were changing the rules based on claims pertaining to roofs. Now, I understand why. Because a lot of people had become aware that the insurance would replace their roof. A lot of people got into the roofing business, going out and soliciting homeowners, educating them about the fact, hey, you know, you can get your roof replaced by the insurance company. So the insurance company began changing the rules, unbeknownst to many homeowners. And I'm going to show you how they have been doing it to the detriment of the homeowner. Now, more and more insurance companies are doing this. They're changing the language in the homeowner's insurance policy. And more of the cost is being shifted to the homeowners. Sometimes the entire cost. Now, can you imagine filing a claim and you end up paying the full amount of the claim? So we need to understand how that's done. Most people don't understand their policy, so they have no idea what kind of policy they have in the first place. So let's cover that first. These are the different type policies. RCV means replacement cost value, pays the full amount. ACV will never pay the full amount. A hybrid is an RCV policy that converts to ACV coverage. And a trigger is what that means in case of an event such as a storm, a certain type of storm. It would trigger or activate certain provisions in the policy, shifting more of the cost to the homeowner. So let's go through a few scenarios so you can better understand what these things mean and how they may impact the homeowner. So the first one is RCV policy. It pays 100% of the claim, as you can see here. So it costs $20,000 to replace that roof. The insurance company will pay the full amount to replace that cost, replacement cost value, minus the deductible. On roof claims, the homeowner will always have a deductible they're responsible for. That will be subtracted from the replacement cost. So now the insurance company pays the difference. In this case, $19,000, and the homeowner is responsible for $1,000. So let's examine how the industry has changed dramatically in past years. So here we have a $10,000 roof. We'll just say this is for a townhome. You know, we have to include our people that buy townhomes. There's a lot of people that prefer to buy a townhome. So their roof would be smaller and it costs less money. So it's $10,000 to have an ACV policy. Now ACV means actual cost value. That means what is this roof worth in its present condition? Let's say it's a 15-year-old roof. It doesn't have to be 15-year-old. It could be some really cheap materials. So what is it worth in today's present condition? Now, it could be depreciated by as much as 70%. So today, this roof is only worth $3,000. It costs $10,000 to replace, but it's worth $3,000 in its present condition. Now, before the insurance company sends a check, they're going to deduct whatever the amount of the deductible is and send a check for the difference. So you need a $10,000 roof. The insurance company sends you $2,000, and you have to come up with the difference, $80,000. Now, let's be more conservative with our depreciation. So we'll use 50% in the remainder of this presentation. So a $10,000 roof depreciated by 50% is $5,000. After the deductible of $1,000, the insurance company sent a check for $4,000, and now you need $6,000. Now that's on a townhome. For a larger roof, such as a detached house, the roof surface is larger. It's $20,000 on this particular roof. It's an ACV policy, 50% depreciation. That's $10,000. We have a deductible of $1,000. The insurance company is responsible for the $9,000, and you have to come up with $11,000 to get this roof done. Now, there's also what's called a percentage deductible. Now, it costs $20,000 to replace this roof. A percentage deductible is not based on the amount of the repair. It's based on the amount of the face value of the policy. The face value is determined by how much it costs to rebuild the house from the ground up. 1% of 200,000 is what? 2,000. The insurance company sends 8. You're responsible for 12. So, as designed, they pay less and you pay more. In the event that the face value of the policy is more, that means your deductible is going to be more. So, in a $300,000 policy, 1% of 300,000 is 3,000. The insurance company once again pays less, 7,000, and you have to pay more, 13,000. So it's very important to understand what kind of deductible you have. Is it a flat rate deductible, or is it a percentage deductible? And I have seen the deductibles as high as 5%. Now, how much would the insurance company have to pay on this claim? Well, if you said 0, you would be correct, because 5% of 300,000 is 15,000. The roof is only worth 10,000 in its present condition, so the insurance company is not going to send you any money, and you are on the hook for the entire cost of this roof. Isn't that something? Here's the hybrid policy. This is actually an RCV policy, which means it pays 100% of the claim. So if something happens to this house, whether it's something, a branch, a tree fall on the house and damage the roof, or something happens on the inside and it's approved, it will pay RCV. However, if it's a storm related, such as hail or wind damage, when this claim is filed, and based on it being storm damage when you really need the coverage the most, now this policy converts to a RCV into ACV provisions that will function just like an ACV policy. But it is an RCV policy. So imagine you have an RCV policy with a $1,000 deductible, and you have to pay $11,000. And if that policy not only converts to ACV provisional coverage, but also affects your deductible, changing it from 1,000 to 1%, and then you have a $3,000 deductible, now your RCV policy has you coming out of pocket and with $13,000. And, heaven forbid, if your deductible changes to 5%, and now the entire cost of this roof, financial burden, has come on you. Now, here's the question. Do you have this kind of policy right now? Was the provisions of your policy explained to you? If it wasn't, how do you know you do not have this type of policy in your possession? Now let's talk about another little trick that these insurance carriers are doing. Here's an RCV policy. There is no ACV provisions in this policy. It is an RCV policy. However, they snuck in a provision that will trigger a change in this deductible. So when there's a hail or wind damage, that will trigger this provision that changed the deductible from 1,000, let's say, for instance, to 5,000. Now the insurance company sends less, you're on the hook for more, and that $1,000 is actually a 500% increase in your deductible, just like that. But they're not limited to changing it from 1,000 to 5,000. They could have a provision that changed it to a 5% deductible. Now, on a $300,000 face value, their payout is $5,000, and you are on the hook for $15,000. You see how they swap that around? All because of the provisions they put in these policies that you have no idea, and more than in all likelihood, you have no idea it's even there. That is why this legislation was put into effect, because the insurance commissioner wasn't doing anything about it. They're the ones that have the power to rein these insurance companies in and slap their wrists and make them behave, but no. So the Georgia legislatures came together and start, thinking about what they could do since May of 2025, and in January enacted this. It doesn't fix the problem. It's just giving you a heads up that this catastrophe is about to happen. So we're going to give you a Band-Aid. Before it happens, you better start getting some money, and we're going to get some money together, and we'll allow you to establish a catastrophe savings account. So you're preparing for your own catastrophe. That's bound to happen. That's a Band-Aid fix. So the best way to protect yourself and to protect those that you care about is become informed about how these policies work and how these provisions they're putting in the policies work. Right now, you know more than your neighbors, than your family members. You know more than probably some insurance agents that sell these policies. You know more about how these insurance policies, how they work, and how they are being designed to transfer the burden of the financial responsibility from the insurance company, which is where it's supposed to be because that's what you pay your premiums for, but it's being shifted from them to you. And the only protection that you have is what we're about to go into right now. First thing you need to do is get your insurance policies out. If you don't have it, have the insurance company send it to you, and talk to your insurance company about what type of policy you have. At this stage, I would say don't even talk to your insurance agent, because they may not realize that some of the shenanigans is going on. The reason I know is because I've had to deal with these claims protecting the homeowner and challenging the insurance company on some of these policies they have enacted. So when you're talking to the insurance company, you want to know, do you have an ACV policy? Or do you have an RCV policy? If you have an RCV policy, does it have ACV provisions? Now, you know what ACV means, you know RCV, you know how it functions, you know how to talk the lingo. So when you ask them these questions based on their response, you can understand what the heck they're saying. Remember, your deductible can change every year. You get a renewal. Your policy renews, and there's changes that occur during those renewal periods. And your deductible is one of those. Check your deductible. Has it already changed? And also your deductible, can it change because of a storm event? If so, it will always be a cost increase to you. Now I'm going to cover this. This is what I used to educate my customers about. I used to educate them about their policy, how it works, some of the features that were really important. And this is one feature that nobody understood 100%. Some people knew about it, kind of had an idea how it worked, but no one was able to tell me how it worked 100% correctly. This is in Section 2. It's called personal liability. It might be called something different in the policy you have, depending on the carrier. But it's personal liability, and what it does, it pays for claims brought against you if if you are sued and you're being sued because you caused personal injury to someone else. It doesn't involve car because that would fall under car insurance. And it's not designed for people that might get hurt on your property. There's a feature in your policy called medical payments to others. That covers those incidents. Personal liability, let's say you're at somebody else's house, you're in, I don't know, subdivision, down the street, you're in another state, even on vacation out of the country, they can potentially cover you. And you cause injury to someone else. You cause them to fall and break their arm, break their leg, break both arm and a leg. And of course, that's going to cause some financial hardship to them. But you're responsible, so they're going to sue you. Or even if you don't think it's your fault, and it could not be your fault, and you get sued by them, the insurance company will assign an attorney to represent you in a court of law. So no more calling attorneys to try to find somebody to represent you, and you spending all this money out of pocket and maybe even go into bankruptcy. No, call your insurance company. And this coverage protects you. It covers your spouse. It covers your children of age, up to 18, from 18 to 25 if they're in college, or if they're 18 and above, not in college. You can add them to the policy, calling your insurance company and say, I want to add my son, my daughter as additional insured on my policy, and it shouldn't cost you anything. Also, if you have a family member living in the house with you or someone else living in the house, you can call the insurance company and say, hey, I want to add this person as additional insured on my policy. They reside in my house. Usually it doesn't cost anything additional, but depending on the insurance carrier, they might charge something. I don't know about every last one of them. You give them a call and find out. Have the conversation with them. Now, the law dictates a minimum of $100,000 coverage. There's no deductible. So pay for your legal fees, court costs, and the amount of the judgment with a maximum of $100,000 as a minimum. However, you can adjust that up. I recommend no less than $300,000. Now, I had $300,000. I called the insurance company up. Hey, how much would, I'm just curious, how much would it cost if I increased this to $500,000? Oh, $10 more? $10 more? Yeah, $10 more a year. A year? Hey, hook me up. That's less than $1 a month for $200,000 additional coverage. Of course I jumped on it. Same thing with medical payments to other. Usually it's $1,000 minimum. Ask, call, find out. How much will it cost if I increase this to $3,000, $5,000? I increased mine to $10,000 because it was so cheap. So do your due diligence. When you're talking to the insurance company and you're asking about what kind of policy you have, you want to ask about this personal liability coverage as well. And don't get caught having the wrong kind of coverage when you need it the most. This is something you need to do right away. Get your policy, find it. If you don't have it, call the insurance company and say, send it to me. They're supposed to send it to you within 48 hours by law. And get on the phone and ask about what do you have. Because you don't want to wait until it's too late. Well, not when you don't have to. You don't have to wait until the anniversary. If you don't like what you have right now, you can change what you have right now. Now, you may have to do some window shopping. So if you have to do some window shopping, there's three types of agents you're going to come across. You have the insurance agent. Basically, when you call into many insurance companies, you have someone pick up the phone. Well, that's the employee. They represent the insurance company. Don't be fooled that they represent you. They don't. It might give you great customer service and make a really nice commission off of you, but they can only offer you what the company has. So if it's a bad policy, they're not going to say, hey, this is a lousy policy. No, they're going to say, hey, you can get this for X number of dollars. And you say, well, that's too much. I want something cheaper. They'll hook you up with one of these RCV policies with the ACV hybrid provisional change. Just one of those ruinous policies that we just went over. Now, you also have the independent agent. Give you an idea of what that is. That's like a State Farm agent, Allstate agent, Farmers Insurance, and there are others. But they are captive. They're restricted in what they can offer you. They can only offer you the policies that particular company provides. They're not employees, but they've decided to lock arms with that company no matter how lousy the policies are they provide, no matter how terrible the company is in terms of being fair when coming out and approving claims or paying on the claim. It doesn't matter just how ruinous their policies are. That agent has decided to lock arms, probably because they pay good and it's a nationally recognized name, and people don't know any better, so business just floods in and they eat really good at your expense. Then there's the insurance broker. The insurance broker actually is an advocate for you. They represent the homeowner when looking for the best policy for you. They have a handful of companies they write business for, 5, 6, 7 companies. Now they may have a big banner on their business, and that's just basically so you recognize they're in the business of homeowner insurance and it draws business in. But they have other companies they write business for. So ask them about these other little known companies, and don't shy away from these little companies, because I have seen these small companies blow these national brands away in terms of performance. So one thing is for sure, smart homeowners insurance protects your wealth, and I think that you understand how true that is. Share this information with others. All you have to do is scan this QR code. It would take you to the app, the Financial Wealth Crusade, and there are other materials in there. Some of it relates to these other pillars of creating wealth through home ownership. But people don't know what I just told you. You know more than they do for sure. So, but how are they going to know if you don't share it? Now, once you scan these QR codes, it's going to take you to the app, Financial Wealth Crusade. You scroll to the bottom, and it allows you to share that app directly from the app. You say something like, share my information. And share it with your family, with your loved ones, with your neighbors, with your co-workers. Everybody that has a home or looking to get a home needs this information. Can you not agree with that? Yes, absolutely. Now, before I go, having been in the business of real estate for so many years, I've seen so much. And one thing that I can tell you for a fact is people buy homes for many different reasons, but the one common denominator is to create wealth through home ownership. And it does not happen automatically just because a person buys a home. That I can tell you for a fact. Because if it were so, how is it that a person that owns their home free and clear, and they're in their homes 40 years, 50 years, they get to the point where they cannot afford to do the repairs, they cannot afford the taxes, they lose their house they had totally paid for because they can't afford the upkeep or the taxes. However, they own the home. Now, isn't owning the home supposed to create wealth? So where's the wealth in that? Where the wealth is in somebody else acquiring that home for pennies on the dollar. That's where it is. So you need these 4 pillars in order to create wealth through home ownership. That I can tell you for surety. So go to the QR code, financialwealthcrusade.com, and explore the information there. Some of it relates to the legacy insurance planning. and strategic money management. But those are just beginning learning tools. Those are tools that are used, but it's just a beginning in the learning cycle, in the learning curve about how we apply these different pillars, how they piece together in order to give it this bulletproof approach to creating wealth through home ownership. Just look at the many things around you, whether it's a bicycle, a car, a computer, a printer. They have different components. And so it doesn't function with just one component of that device. They need the other components too, put together. So same thing with creating wealth through home ownership. You need not just one component, which means owning the home. You need other components too, and you just saw that with our presentation on small homeowners insurance. You have to have multiple. You have to have the right components put together in the right manner, and we can show you that once you contact us or leave your information after you do the questionnaire. Leave your information and say, look, I want someone to reach out to me and show me how these 4 pillars of wealth can work for me and build a bulletproof financial approach to creating wealth through home ownership. Well, that's it for me. Go out and bless somebody, and be blessing all your undertakers in all of your undertaking as you do good in the world.